Welcome to the Dalton Nickel Reid Monthly Investment Review for August. My name is Mark Siddewy and with me is our Chief Investment Officer, Jamie Nickel. This month we'll focus on the reporting season before reviewing the impact of the macro factors on our portfolio positioning. August was a busy month for the Australian stock market, with the majority of companies reporting financial year results that were broadly in line with market. On the macro levels, mounting global deflation fears on the back of China's devaluation of the yuan saw heightened volatility in the markets. The Shanghai Composite Index was down 20% for the month at one point before rallying to finish still down 12%. The market is still uncertain about a rate hike coming September, with the market now pricing a 25% chance of this happening, down from 50% the prior month. I'll now hand you over to Jamie.
Thanks, Mark. So we had a very busy month in August. We had a lot of our companies reporting their results, so a lot of work to be done reviewing the bottom up. And then, of course, there was a lot of macro factors such as a slowdown in China, where the Federal Reserve is going to lift interest rates, which really impacted the performance of stocks. So a very poor month, as Mark was discussing. Given it was reporting season, we thought we'd highlight what we're seeing from a bottom-up perspective this reporting season and just how our companies were tracking. So the first thing we'd say from reporting season is it wasn't the best one. Earnings for 2015 are going to be slightly negative at 2%, largely driven by resources. If you exclude resources, a little bit more reasonable earnings growth of about 8%. Now, if we look at the major themes that we saw coming through reporting season, the first one is that top-line revenue growth remains difficult. We show this chart of sales growth, and you can see it's slowing. The number of reasons for that. One is resources energy revenues are going backwards thanks to the commodity prices. Banks revenues reasonably modest, circa 2%, reflecting competitive environment. Major industrials like insurance offer flat growth. And I think generally many investors are preferring a higher payout ratio, so companies are paying higher dividends rather than reinvesting in this business. And so, of course, a natural result of that policy is going to be flatter revenue growth going forwards. So while we had flatter revenue growth, we did find some spots where we were seeing better areas of growth, and some of those included stocks within our portfolio. So I want to talk about that. Key areas of growth that we really saw consumer stocks offer some pretty good growth, and that was on the back of lower interest rates. They were cycling a poorer year the previous year, and of course we had an easier budget this year. So stocks like JB Hi-Fi, Harvey Norman, and for us Supercheap had some pretty good results. So Supercheap, after a couple of difficult years, highlighted sales growth of 7%, strong like-for-like sales since year-end. So stock reacted reasonably well to that result. Then we look just more broadly at housing-related exposure. Again, getting boosted by recent activities. The concern we've got with housing and consumer is whether we've seen the best of it, and that will start to slow over the next year. But when we look at Lease, which was a very good result for us, they delivered profit which was in line with expectations, however showed very good progress on key performance indicators such as their development pipeline, which is up 19%. Their construction backlog was up a surprising 7%, given they lost the East-West Road in Melbourne, and their funds under management are up 31%. So the balance sheet's very strong. They've got $2.2 billion in debt. They've pre-sold a lot of revenue. They've got tremendous transparency of earnings for the next 3 years. Stock's been quite weak on the back of concerns around housing, and I think it's been well and truly oversold. Of course, not all of our companies reported good results. We also had some stocks which disappointed. And what I thought was really notable was the fact that those companies which were reinvesting for further growth down the track were marked down. Seek was the most notable, delivered 20% sales growth, and they're flagging 15 to 18% sales growth next year, but they also flagging only 5 to 8% profit growth, and that's what disappointed the market. I've put it in this chart here, just the history of Seek, and you can see their revenue growth across all their key divisions since the inception of those businesses, around 32% per annum across the group since 2004. And when you look at their EBITDA, their profit growth has been 47%. So they've just had a tremendous track record of reinvesting in their business. They've now got a global platform. They service all the big populations of Latin America, Asia. They've obviously got a dominant position in Australia. They're building out product, rolling it out across that global platform. And we think management deserve to be backed. They've got a good history and track record of delivering on those reinvestments. And while it might mean over the next year profit growth isn't quite so strong, I think if you look forward and take a long-term view and you see them reinvesting, you can see very strong growth. So while the market's got very short-term on the stock, we're happy to take a longer-term view, and I think that's how you tend to make money in equities, is taking that longer-term view. The other stock that reacted quite similarly, but perhaps not quite so harshly, was Vita Group. They delivered a result which was in line with expectation. Revenue was up 12%, as was their EBITDA profit. Management flagged similar level to next year, which was broadly in line with expectations. However, they also flagged a slightly higher amortisation charge and a higher capital expenditure next year. And that's what disappointed the market. And I think it's partly a communication issue, because management didn't spend a lot of time really enunciating the revenue that's going to come from that capital expenditure. But I also think it's that short-term nature of the market, really focusing in on the short-term costs associated with the reinvestment rather than the opportunities that are arising from a range of opportunities for Vita, including regulation such as anti-money laundering legislation, comprehensive credit reporting, know your client. There's a whole lot of legislation which Vita are creating products to make life simpler for people using the product, and it creates a whole lot of data which they can use, and they're trying to monetize by speaking to a whole lot of financial technology companies and the like. So we continue to think that long-term opportunity for that. Like Seek, they're amongst the best two sort of growth companies in the market as far as we can see, and like Seek, we're more than prepared to back that company. Probably the other notable disappointment through the reporting season was a number of the offshore companies disappointed. Now, that might be a surprise, and it was a surprise to the market, because you think of the offshore companies as benefiting from the Aussie dollar. However, a lot of the offshore companies went, during the period when the Aussie dollar was going up, they started reporting in US dollars. So what that means is, as the Aussie dollar comes down and they convert Aussie dollar profits into US dollars, it means their US dollars earnings are going backwards. So it's quite a sort of complex sort of situation. Market misforecast that a little bit. It's not a major issue. Obviously, the valuation impact of the lower Aussie dollar overwhelms that translation impact. We didn't have too much exposure there, but Brambles probably got caught up a little bit in that issue. Then, probably on the positive side, a lot of those companies undergoing cost out and self-help remained a big focus for the market. You can see industrial profit margins. You can see the pickup from 2014 to 2015 in this chart, and the expectations going forward. Given that we're not seeing it in sales growth, it's obviously cost out that's driving that improvement. And for us, we had Horizon, QBE, Macquarie Atlas all deliver quite good improvements on pretty flat revenue growth. Horizon had EBIT profits up 14% on flat revenue. QBE had profit up 26% on flat revenue. So they're pretty good outcomes, and they're lifting their dividends quite substantially, which is obviously good news for shareholders. Looking at resources, which have obviously taken the brunt of market moves in recent months, the actual results from a bottom-up perspective were reasonably good. What we'd say is they're controlling what they can, taking costs out, reducing capex. You can see BHP here. You can see their cost improvements across their major commodities. They've made significant headway. And the way to read this, if you look at coal, basically they've taken out half their cost base. So that astonishing, really, numbers when you look at it. And then if you look at other companies like Rio, South32, like BHP, taking significant cost out. they're obviously hostage to commodity prices. So if we see some stability in commodity prices and maybe a little bit of increase, they're going to get a lot of profit leverage as a result of taking that cost out. It's a wait and see game. We think supply is going to drop out of the market in the next over the next year, probably in acceleration really, and that might help to stabilise things in some commodities. Looking at the banks, they were caught up in some of the macro concerns, sold off quite aggressively through the month, started to stabilise now. But one of the issues that market became concerned about, or certainly some offshore investors did, was on bad debts. And if you look at this delinquency development chart from Genworth, this was one of the things that triggered the concerns. What this chart shows is the seasoning of mortgages, and you can see the different dates and you can see the shape. You know, probably the peak time when mortgages, you get your most delinquencies is about 3 years. You know, the enthusiasm of getting a new mortgage has been overwhelmed by the pain of paying the mortgage, and some people start to fail to repay. But once you've held it for longer, your pay rises are coming through, you've got a little bit more equity in the house, you're much more interested in making the repayments. You can see the worst year was 2008, and you can see recent history has been very, very good. But you can see just a little tick up in recent months, which seems to have bothered the market, and I think it's a really gross overreaction because those loss rates are incredibly low, and the most investors, given low interest rates, are paying off their houses at a faster rate, so savings rates are quite high. So the average loss on a mortgage in this Genworth result was 49 grand. Really nothing. And while there might be a few pockets in some regional mining type areas, it doesn't look like a widespread issue at present. Okay, so a summary of the reporting season was we had a number of results which were reinvesting and poorly received, Seek, Vita, Brambles. Then we had a number of companies increasing dividends and were very well received, Horizon, QB, Macquarie Atlas. Then a whole range of companies which we thought delivered really good top-line growth and operating in little niches from healthcare to exporters to aged care, service industries. That's those ones I talked about earlier: Treasury Wines, Estia Health, Myob, Supercheap, ResMed and Lendlease. Then there were some good results, but they were overshadowed by macro events, and that's really the banks and the resources. They were pretty sound results, I'd say. CBA was a good result, as was the resources, but it's beside the point at the moment. It was the macro factors driving those stocks. So if we look forward to new valuations, the key things we're looking at is those stocks which, like Seek, delivering top-line growth but are marked down by reinvestment. Perhaps there's some other opportunities there. We're looking for other stocks exposed to those growth sectors. Gaming was a sector that stood out during reporting season, and perhaps a few more undertaking some of that self-help to deliver good outcomes. And just a final word on market valuations. We've seen markets start to settle down over the last couple of days, which is a relief after very harsh treatment last month. And really it was triggered by that Chinese volatility. I would say though that we think the Australian market, there's some reasons to be a little bit more optimistic. And if we look at those, we've seen a sharp fall in the market, down 15%. The PE of the market's now below average over the last 15 years. And the yield is very strong, particularly relative to interest rates. Probably never been higher over the last 15 years, or certainly hasn't. And then if you look at Australia, well, we're probably a little bit more concerned about the Australian economy in some respects. The fall in capital expenditure. What we do think is corporate balance sheets remain in good shape, and Australia has good ability to stimulate the economy with interest rates higher than other parts of the globe. Our government debt levels lower, so there is that ability to stimulate our economy relative to other markets.
Thanks, Jamie. In response to the market volatility, we've made a number of moves in the portfolios. We've been using the weakness in the banks to reduce our underweight position. So we have bought Commonwealth Bank of Australia and sold a smaller amount of Westpac. Key reason is that CBA is looking cheap at 12.9 times, but furthermore, the grossed up yield is very attractive at 8.4 times, and this is for one of the highest quality banks in the sector. We've also added to our stake in analyse, which we think delivered a great result. Pre-sold revenue of $5.2 billion was up over 100% on the prior year. So this really underpins the company's earnings visibility for the next few years, and we note that the valuation of the company is trading below the market. We've also bought an additional stake of Macquarie Group. Despite upgrading market expectations in July, the stock has rolled off with the market. The growth outlook remains robust as they benefit from steady growth in funds under management. We think the business is trading cheap relative to the earnings growth on offer. We've also bought more shares in Seek, despite them delivering a disappointing result. They have guided to a 15 to 17% sales growth, which is really strong in this market, but they're only flagging a profit growth of 6%. This is partly due to some reinvesting they are undertaking, but also due to a fall in the education business, as regulation changes are designed to reduce upfront commissions, so this reduces the cash flow payments over future periods now. But if we adjust for these impacts, the underlying growth rate is still strong at around 15%. So we took this opportunity to increase our position, as there are not that many businesses with this type of sustainable growth outlook at these levels. This concludes the Dalton Nickel REIT monthly investment review for August. Thank you for your time, and we look forward to talking to you again next month.